What makes tail risk risky in short premium trades?
I think the answer's in the question.
What makes tail risk risky? Let's take a look. Short options are dynamic products. We just went through an unbelievable period where short options, especially short puts, exploded. So everybody's very familiar with this. This means exposure is dependent on many variables that go beyond the traditional ways of measuring risk. Basically, fooled by randomness is where we're going to go with this. Today, we look at what metrics we use to gauge risk and what not to overlook. What are the different types of risk that are most important to recognize with short options? Tony, what's the single most important thing?
So we're going to throw out size. We're going to throw out size.
Not throwing out size.
Oh, I would say size is probably the single most important thing, and then avoiding the dynamic move in the market, which you can't do. So size would have to be the king.
There's lots of different kinds of risk, but the part that most people don't recognize is size. Mm-hmm. When looking at the distributions of short strangle P&Ls, we see the three main metrics that we gauge profitability and risk by. These are just our gauges, okay? There is the average of 95% of the outcomes. That's inside of two standard deviations. That's where we figure, and as a firm, we measure most of our risk. There is CVAR, which is the 5% of the worst losses. We actually display CVAR on tastytrade, and we obviously display the average of the outcomes on Tasty. What we can't quantify is the tail risk and the worst cases, which we write as unpredictable, uncontrollable, and the only way you can control it is by size. So when you look at this, we can give you the C-bar, we can give you the average of most of the outcomes, but on the unpredictable stuff, the only way we can control it is by size.
You think it would be strategy too, right? But you know what's going to happen? Right. Each strategy has their own probability of success. And if you get some sort of move, like you would think that, like you might say, hey, an iron condor or a vertical spread, even if you're wrong, say I put vertical spread and we go lower, that's going to be a better use of your capital. And also not only is it going to help you with the outlier move, well, what if the move never comes back to your spread? Then you're a full loser on that. Where a naked option, if you're mechanical, you might actually make money on a move back into the zone. It's hard.
There are there are a lot of things that people will tell you about, everything from being smart about fundamentals and being smart about, market awareness and being smart about stop orders and things like that. The reality here is the only way you can control the unpredictable is by size. Mm-hmm. We like to use a really bad analogy, which is a car accident. When you get in a car, you can put your seatbelt on and you can decide to drive when you're not drunk.
You can break the law, drive when you're not drunk and not use your seatbelt.
You can drive when you're sober and you can put your seatbelt on. You can control the thing and you can control your speed. You can control everything that you possibly can control when you get in the car. You can't control things that other people do. And we call that the unpredictable. And so it's the same thing with trading. You can control your size. That's it. And you can control the efficiency of the products you're using. Let's go to the next slide. So we did a study, because this is a market measure, for 10 years. We sold Strangles. We managed at 21 days. And we looked at lots of different things: average P&L, average profit, average loss, C-bar, largest loss. Let's go next slide, Beth. Okay, so this is where it gets really, I love the graphics these guys use for this. Notice that when you increase the delta of a strangle, the average profit and loss scale proportionally. So this shows the range of most P&Ls minus the outliers. All the averages for 30 delta strangles were around 45% larger than the 16 delta strangles, and so on. So you can see 16, 20, and 30. Everything is proportional. But what we do is we try to figure out, which is the risk world we want to live in.
That's correct.
It's not like you're
Like one is overly better than the other.
That's
looking
right.
At all these numbers. Yeah.
That's right.
Yeah.
But where do I make the most money with the least amount of risk and the least amount of challenges and the most sleep at night type thing?
I mean, if you look at just which a lot of people do when they're trading, they look at where can I make the most amount of money. You would go to that 30 delta. If I just showed you those 3 green bars of the 2, you'd say, oh, I'm going to do the 30 delta for sure. But you've got to take a look at what the loss could be too.
When you look at this proportionally, you're going to probably lean towards the 16 delta, or whatever, just because you're thinking average P&L. But let's keep going. There's a lot of takeaways here. So let's go next slide. So this one's C-bar. This is the worst 5% of all cases. So the C-bar for the 30 delta strangle is 45% greater than the 16 delta strangle. The worst case outliers for the 30 delta are about 16% larger than the 16 delta. These proportions are similar to the ones on the previous slides. So essentially what we're saying is when you start to look here at the average of the worst 5% of all trades, okay, you can easily, rationalize, justify anything that whatever case you want to make, put them all together. We're just showing it to you.
Sure.
This is what we do really well at Tasty. We just show everything, and then we'll tie it up at the end, and and try to get you to a spot where you think is kind of the sweet spot. But you can see where we're going with this. The sweet spot in the 16 to 20 delta range. Let's go to the next slide. So this is a cool graph. This shows that as delta increases, the losses grow larger, especially in extreme cases. The 30 delta strangles face bigger average losses and much more, tail risk. And so, it's.
I mean, it goes 30, 20, 16 as you would suspect, right? Like there's no intersection of lines anywhere. So, I mean, the pricing stays pretty consistent.
No, and so you can decide kind of, you decide where you want to be on that. But obviously, you take significantly more risk at 30 deltas than you do at 16 deltas. That's all there is to it. Let's go to the next slide, Beth. So this study shows that higher delta strategies face both larger and more frequent losses. The 30 delta strangles, or 30 delta strategies, lose 31.5% of the time with a $460 average loss compared to 26% and a $334 loss for the 16 delta, compounding overall risk. So you want to make more money, you take more risk. You're willing to take less money, you take significantly less risk, and you have fewer losses. This is how the game is played. This is where everything is normalized. It's essentially we commoditize everything based on efficient market pricing. And so just to point this out, again, it's where do you want to be on this scale? Mm-hmm. Do you want to have more losses and make more have more losses and bigger losses and potentially make more money, or have smaller losses, lose less time but make less money?
We like to opt for the higher probability.
We like to opt for the higher probability of profit. We like to opt for more wins.
Yep. Again, this is a personal thing, right?
Yes. Let's go to the next slide. So notice all the metrics scale to a near perfect proportion depending on the delta of your strangle. So all the metrics for the 30 delta strangle were way greater than the metrics for the 16 in terms of risk. Yes, that is the case. That's exactly what we wanted to show here, was that everything scales in near perfect proportion. And the 16 delta has a lot more risk than the 16 delta. I'm sorry, the 30 delta has more risk than the 16 delta. Let's go to the next slide, Beth. So some of the takeaways. The tail risk inherent to short premium means that outlier losses of a strategy will always be much higher than the average risk reward of the strategy on a trade-by-trade basis. Staying small is the only way to protect against the sudden shock of a 5% outcome. And the delta of your strangle will effectively scale the exposure to all the metrics: profitability, normal volatility, C-bar, and outlier risk. I think all of those are common sense, but we wanted to point everything out to you.